Hi guys, today I'm going to be speaking about Equation DAO and their burn mechanisms and kind of go through who they are, what they are, and why you really should be paying attention to them and possibly start to invest. You can check them out on their Medium page. You can find the link in the description below as well. And I will be going over the price chart that they have and kind of show you what's up with this. So stick around. Now, the Equation DAO burn mechanism proposal. So what they're looking to do is have it's scheduled for December 23. This is the full-scale launch of this, but now the features of this: the users who stake the EQ receive an equivalent amount of VEQ on a one-to-one basis, right? And so they're looking to have it fully operational, and it will serve as a sole basis for governance voting. So their motivation behind this, of course, is that because of the mechanism, users have the option to stake their EQ mining rewards, or you can sell them on the market. And those people who stake them and lock their EQ demonstrate those long-term confidence in the project, versus having just go ahead and selling and closing out, which puts that sell pressure going on. But because of all of this and the current mechanisms that they have, it doesn't really help the long-term investors because those people that are selling short-term, it actually affects the long-term investors as well. So they're looking to change that. The specifications, so you have 90, 60, 30, and no lock. So the 90-day lock is 100% mining ratio. There is no burn ratio. 60 days, 75% with a 25 burn ratio. 30 days, 50%. 50% burn ratio, and 25% mining ratio to the 75% burn ratio. But they're looking to have now this vote is scheduled to be, or was scheduled to be on November the 15th. It was going to last, and it lasted for about 2 days. But who are they really in total? It's built on Arbitrum and the innovative BRMM model. It offers up to 200x leverage for some traders, and it can even go up to 50% for liquidity providers. And that's going to allow some traders to actually make a much larger and unrestricted position risk. So the MMR is about 0.25%, and the capital efficiency for LPs. But as one of their DeFi protocols, they're looking to actually have the fair launch equation stands. And the fair equation is standing as a very strong testament, or a very strong power of the community. So they're showing this as well. And it's actually prioritizing security and giving transparency that allow the traders to feel reliable and secure environment for perpetual trading. Now, this is just the equation, but they also have a proposal for implementing a time diminishing position. And what this really means is that you're going to get greater rewards for users who are actually opening new positions, but also helping the long-term position holders without affecting them. So what's going on with this is going to allow them to share the protocol's growth, and the position mining rewards are distributed based on the proportion of positions held by the users. And so the overall size and positions increase, and the incentives for the users opening new positions will become a little bit smaller. But they're looking to increase the incentives for users opening new positions, but making sure that the long-term position holders continue to receive their ongoing rewards as well. So here's their mining coefficient, right? Here you can see it's like the position times the position mining coefficient, and that's divided by the position size, position mining coefficient times, and then times per unit permissions. And they voted for that in November as well. Also, the Pool 2 mining proposal, they have this. They're looking to actually make a new approach to mining, and it's called the Pool 2 mining. And it's designed to reward the liquidity providers, the LPs, for their EQ and their Ethereum pair on Uniswap. And that's, if you want to buy this and check that out, you can jump to Uniswap and buy it there as well. But they're looking to take in a little bit more of balance of a development to this. So what they're trying to do here is the EQ of tokens is really insufficient, and it's actually a bottleneck. So it created a bottleneck and actually hurts the ecosystem's growth. And they're looking to kind of go through that bottleneck by the Pool 2 mining and promoting a really more balanced and swift development of equation. The specifications for it, now the user is going to be able to participate in 20% of the emissions. Here we can take a look at the allocation. So position holders, 40% of the total emissions of the pools, they get around 6.4 of the emissions. The RBF liquidity providers, they get 16% of emissions. The EFC member NFT holders, now they're going to get 16% of the emissions. The EFC connector NFT, They get 1.6% of the total emissions, and the pool two liquidity providers, the LPs, they get the 20%. So they're kind of breaking it down for you as well. And here's the market for them as well. If we take a look at the month, just the month alone, 334%. There will be some retracements coming back and forth, especially well, dailies, weeklies, like how the market does in general. Little fluctuations, but it will continue to grow as well. And this is something you can see at 35 bucks. It's not bad. It's actually really, really good. And even the yearly, 440%, and the all-time 440% as well. So you can expect this to really will jump up and go even higher. And you can see the markets more with the volume that's kind of coming up around 47.17% with the price as well. So you can check them out on CoinMarketCap and catch some more information on them as well. Guys, thank you for watching, and I will catch you again next time.